Thank you, sir. Good afternoon to one and all present here. I, Rakshita Prakash, on behalf of Oxford College of Business Management, take immense pleasure to welcome you all for the one-day workshop on portfolio management. The Oxford College of Business Management has always kept us pace with the changing need of the hour. Our college focuses on three core principles: education, research, and social participation, and we incorporate all three into our commitment with students and stakeholders. Next, it's my privilege to welcome Dr. Nikita Alur, Principal, the Oxford College of Business Management, who has been guiding force for all of us in the events that we conduct. Our advice and support in all the events has led us to the position where we are today. Our motivation, encouragement is the source of our success. We heartfully welcome you, ma'am. It's my great honor and privilege to introduce you all our speaker of the day, Professor Dilip. Professor Dilip is MBA and MPhil graduate and pursuing his PhD in the area of stock market. Portfolio construction at Bharatiya University, Coimbatore, Tamil Nadu. He is presently working as assistant professor in the Department of Finance at Avi Institute of Management, Bangalore, and he has 13 years of teaching and research experience. He presented and published around 8 international papers and 10 national papers. He has been awarded twice as the best employee of Avi Trust. He has received the Best Research Paper Award, along with 10,000 cash award in international conference. The title of the paper, An Empirical Study on Impact of Exchange Rates on Indian Stock, conducted by ICFAI Business School 2019. He has presented and received the Best Research Paper Award in International Conference. The title of the paper, BRICS, Countries, Stock Market Movement, and Empirical Analysis, conducted by RNS Institute of Technology in 2019. He owns Certificate of Recognition from Avi Institute of Management for building good research proposal on 25th July 2020. He has received the Best Student in MBA 2008 and also got the Best Manager in Degree 2006. Countries, stock, I request all the participants to disable the video and audio. Kindly put across your questions in the chat box, which will be answered at the end of this session. Sir, we welcome you, sir. The session is all yours. For building Thank you, sir. Good research proposal.
Thank you so much for a wonderful introduction. Just let me know that am I audible to you properly?
Yes, sir. Yes, sir. You're audible.
Thank you so much for the confirmation. Meanwhile, I'll share my screen. Give me a minute. Is it visible?
Yes, sir.
Yes, sir. Yes, sir.
Thank you so much. Thank you so much. Good day, everyone. It is indeed pleasure to be part of this program. First of all, I thank Dr. Nikita Madam, Principal of Oxford College, for providing me an opportunity, and also I thank Dr. Chitra Devi for inviting me as the resource person, and all the staff members of Oxford College. I thank first of all. And let us proceed with the discussion. So our discussion is about the portfolio management. First of all, especially when we talk about the portfolio management, let us give a background, the reason for this portfolio management, what I'm discussing with you. If you look at the inflation rate in India by 2020 point of view, it is almost 6.2%. If you look at the fixed deposit rates or bank rates, interest rates of your deposits, which is 4 to 5%. So it is mandatory that we have to invest our fund into the different areas where we have to earn more than the inflation rate, so that so that we can survive. Okay. With this background, let us proceed our discussion. I request the coordinator, please let me know if any specific question in between, if you find that it is logic and it is need to ask at that particular point, please feel free to ask me a question, or else at the end you compile and you can ask me a questions.
Definitely, sir.
Thank you so much. The first disclaimer here is I'm not the investment advisor. No stock recommendation in this session, even though practically we are going to calculate, we are going to do the portfolio construction, okay, but no recommendation from my end, okay, so you have to use your analysis part on that. And the scope of this discussion is only the portfolio construction for equity shares and wish to apply the existing model in Indian context. Now, what and all I'm going to cover, it is a really challenging job to me that, especially taking, afternoon. My ex-principal used to say that when Madhya Pradesh is full, okay, Uttar Pradesh won't work. Okay, so afternoon, it is equal challenge for me to give this particular lecture or session, very much practical, so that everybody will be benefited out of this. So content for the discussion here is, we will understand what exactly the investment, what are the different avenues of investment and portfolio management, and stock market instrument and stock exchange in India, methods of portfolio construction, testing of single index model on BSE Sensex stocks. Believe me, trust me, I won't discuss the theoretical part, okay, much time I'll be spending with you the practical aspects. Since the the population over here is hetero, I just wanted to have a common platform so that I'm discussing here with you the basic investment and investment avenues point of view. Okay, I'm not going to discuss in detail of those things. Okay, with that context, let us proceed. All of us, we are aware that what is meaning of investment and all details we are aware. Okay, in simple term, what exactly the investment is all about. Okay, many times we would have heard about the investment, and also we read in the books, okay, investment definition and other things. In simple term, to understand anybody, any common person who can understand what exactly the investment is, to sacrifice something today for future benefit, we call it as an investment, which is nothing but, as people, you are just parking your investment into the different avenues of investment. You're just parking your investment to different avenues of investment, either with the aim of getting the good returns or with the aim of capital appreciation. That is called as an investment. Okay, so now before jumping into the portfolio concept, which we have the workshop on portfolio, directly entering into the portfolio, let's try to understand what exactly the investment. So now we understood what is investment is all about. Okay. So now when I say that here, a person is parking their savings into the different avenues. Okay. So let us try to understand what are the different avenues where people do park their money. Okay. So let's see here. These are all the different avenues. I have given few avenues. There are n number of avenues. Okay. So people do invest into the gold, silver, either it may be the fixed deposit or it may be the recurring deposit or any of the banking deposits. It may be the mutual fund investments. It may be the real estate or purchasing of land, building, house, construction of the house, okay, or taking the different insurance. Usually insurance, we specify that it is not exactly as an investment, rather we consider this is a risk coverage. However, let us try to understand here. I'm discussing with you all the avenues. These are all the different avenues. Okay. Nevertheless, even including with the stock market investment. Okay. If any person makes more than one avenue of investment, okay, let us assume that a person would have bought the gold as well as fixed deposit, or he would have taken the mutual fund. The combination of this investment is called as a portfolio. In simple term, I'm discussing with you. Okay, so this is called as a portfolio. All of you agree with me. Okay, our parents are the better portfolio investors. If we look back, their investment strategies or investment plans and all, okay, every year they used to buy little gold. Okay, every year they do make fixed deposits for children's education or retirement purpose or whatever it may be. Okay, they do invest into the different mutual fund, or they would have bought house. Okay, they would have bought land. Okay, they would have constructed the house. Okay, they would have taken a different insurance. That is nothing but a portfolio. That itself is nothing but a portfolio. Now I'm taking you from towards the investment towards the portfolio. All of us, we understood that portfolio is nothing but investing into the different securities. That is, we should understand here. Now the question here is, when we invest into the portfolio, okay, as I told you, there are many aspects over here for investing into the portfolio. What is my discussion is all about in this session? What exactly I'm going to discuss? When I say that portfolio is an ocean again. Okay, maybe within a given time cannot be covered the portfolio concept at all. Okay, hence I have taken here in my discussion, portfolio is only the stock market. Now I'm not going to discuss any other information rather than the stock market information. Okay, so with this, let us proceed the next point. When I specify that in the stock market, again, the bigger challenge to me here, okay, in stock market, there are many instruments. Okay, when we go for investment in stock exchanges, okay, we do, many of the students, they're not aware that they consider that only the stocks are traded in the stock market, or equity shares are traded in the stock market. No, even bonds are traded in the stock market. Okay, quickly I'll show you the pic of the real trading activities. Okay, so even bonds are traded in the stock market. Then there is F&O, future and option, which comes under derivative instruments. So you can have investment or trading activities either with the bond or with the derivatives, that is futures and options, or you can do the currency trading, or you can do the commodity trading. You can invest your money into the commodities. Okay, so such as a precious metal, okay, agri products and other things. Okay, so again, the question here is, portfolio, we supposed to do it portfolio construction, but in the stock exchange, there are many instruments. Again, my discussion is only on equity share. I'm going to discuss with you, okay, portfolio construction for equity shares. These are all the simple slides. I need not to spend much time. Okay, so as I told you, bond. Okay, you can see here as per the today's date. Okay, there are many things. I just took a snap of that and I'm showing you here. Okay, these are all the different government and non-government bonds which are trading. This is all the different bond types with credit rating, information all here. Okay, with coupon rate. Probably you would have studied in your degree. Okay, bond valuation. Okay, with coupon rate. Okay, with the last traded price and all. Okay, you would have studied. Okay, so this is what even bonds are traded into the stock market. Then even derivatives, that is either it may be the index derivatives or it may be the stock derivatives or even currency derivatives are traded in the market. Again, commodities also traded in the market, but majority of the cases in MCX commodities are traded, okay, than the equity stock exchanges. But however, in equity stock exchanges also will be traded as per today's date. Okay, these are all the commodities which are listed are trading over here. What I'm bringing to your notice here is for the students. I'm discussing here investment in stock exchange. There are many instruments, but our portfolio construction is restricted to the equity shares. All this, I'm just giving you the snap or picture of that. So all those things are just snap or picture of that. Okay. Even currencies are traded. You can see here. Even currencies are traded. Okay, this is as per today's date. So this is all. Even you can trade in the market. Now, coming to, we understood that out of all the trading activities or instruments, we select this stock exchange. Again, the bigger question here is there are many stock exchanges. Okay, recently around 20 stock exchanges have been closed. But as per the SEBI information, okay, presently we do have these are all the 9 stock exchanges. All of we are aware that BSE and NSE's information. Okay, so all these are all the 9 stock exchanges as well. Now, when I say that portfolio construction, and especially portfolio construction in equity, okay, and we can select among all, okay, any of the stock exchanges, either with NSE or BSE or whatever we can select, okay. But the bigger challenge here is NSE and BSE, okay, there are more than 6,800 plus companies are listed in the stock exchange, and around 1,300 plus companies actively trading in the market every day. Again, the question mark here is how do we select the companies and how do we make the good portfolio? Taking 1,300 companies and analyzing, again, is a really bigger task. Okay, so here, this is what our challenge lies. Okay, how do we select the companies and how do we create a portfolio is what we are going to do it. Okay, and this entire session is on practical. Okay, we will check it out, the calculation part also. When I specify here the portfolio construction, there are amazing models are available. Okay, so Harry Markowitz model, William Shedd single index model, Robert F. Engel model, and BL model is also called as a Letterman model. Believe me, all these 4 models, whatever I have just highlighted, okay, all these 4 model which received a Nobel Prize, okay, under economics. The first portfolio construction is this one, that is Harry Markowitz model. Harry Markowitz model, they created a portfolio construction. This is the first gentleman who identified a concept of risk in portfolio, and he constructed a portfolio by using correlation method. Okay, and of the disadvantage of correlation method, or here is one of the disadvantage of correlation method here is, if by chance a person takes 30 companies for his portfolio construction, okay, required around like n into n plus 1 divided by 2. That is 30 into 29, okay, divided by 2, which is leads to be, I think, 465 correlation required to do just 30 companies correlations. 30 companies correlation between the one stock to the other stock, among and between the stock to the stock, required 465 correlation I need just to take 30 companies for my portfolio. So that is the biggest drawback here. Further, this model is developed by William Shap's single index model. And to overcome with this drawback, okay, he introduced a concept called as a beta. He introduced the concept called as a beta coefficient. Okay, and he's comparing all the beta coefficient with the market. Then if at all, if I'm taking the 30 companies, okay, I need 30 beta, that is sufficient to construct the portfolio instead of 465 correlation. Instead of 465 correlation. So that is the model which developed by William Shap's single index model. Give me a minute. So till now, whatever I have discussed, it is the just basic concepts of the model, initially started by Harry Markowitz, and the same study further developed by William Shap's single index model. And coming to the another two model, which is a very important model. If anybody wanted to have your career on equity researcher, okay, so you should learn these two models. Okay, I think more unfortunately these two models are not given in the university syllabus, but these two models, which also got the Nobel Prize, majority of the companies uses the model, these two model. Okay, one is Robert F. Engel model, again during 1980s to 1990s, which developed the model, and BL model, which is a 5-factor model. Okay, so these two are amazing model, which majority of the currently the industries are using these two model. Okay, initially started with the Harry Markowitz, okay, then followed with William Shap's single index model, and further they have developed with the portfolio construction. Now, this is other fundamentals. What is this other fundamentals? People do have their own fundamentals, like they consider that certain fundamental aspects or technical aspects, and they keep the parameters. Based on the parameters, they select the companies and they do invest their money into that particular portfolio. Okay, so we are not going to discuss the other fundamentals here. Now, our concept, our today's discussion is on this William Shap's single index model. Okay, so why William Shap's single index model also I'll explain later part. Okay, so let us try to understand. Okay, here initially developed by the Markowitz model, further followed with Williams-shaped single index model. Okay, this model coming to the, okay, here's the gentleman, Williams-shaped. Probably many of you would have used a concept called as CAPM. Sorry. Yeah, believe me with my okay, bear with me, the handwritings of mine. Okay, so CAPM, capital asset pricing model, is developed by Williams-shaped. Okay, so he's the gentleman who developed the further model called as a Williams-shaped single index model. Okay, and more surprisingly, he developed during 1963 in US, and that is what, the Williams-shaped proceed with the work done by Henry Markowitz, and he considered the market index while determining the portfolio, which I have explained to you. Instead of correlation, he calculated based on the beta value, okay, or regression point of view. Okay, so, and he developed the model called as SIM, that is shape single index model. And very surprisingly, during the year 1990s, he receives the Nobel Prize under economics, okay, for his great contribution of CAPM and index model. Okay, so now we are going to test. Here only the curiosity takes place. What is the curiosity over here? The model is developed in 1963, which indicates that almost 60 years back, the model is developed. 60 years back, model is developed. And many of the European countries disagree that the model does not work into their country. And many of the countries agree that, yes, the model is really, applicable to their country. Okay, now the real challenge, the real research work start here. Is this model applies to Indian stock market? Is the question. Okay, believe me, many of Indian companies uses for, if you check it out, the annual report of the company, okay, they do adopt CAPM model for determining the cost of equity into their company. Okay, so to give you example, you just download the recent annual report of HUL company. You will be finding the CAPM model. Okay, so now the question arises here. Okay, is this model, which invented during the 1963 and received Nobel Prize during the 1990, and still that too it is in US market, is it applicable after near to 60 years? Okay, is it applicable? This model is applicable in Indian context. Okay, that's what motivates us to do this study on this. Okay, here the steps I have given. First, the first one here. Okay, find out the excess return to beta ratio for each stock under consideration, which is nothing but we have to identify return of the stock minus risk-free rate divided by beta coefficient. Beta coefficient. Okay, so this is nothing but excess return to beta ratio. This is the first step. After identifying this, the second step is rank them from highest to the lowest. And third one is then calculate C, that is cutoff rate we have to calculate by putting the formula what I have given here. Okay, I'll come back to this formula later part. Let's see for here. Okay, what is the variable required? Okay, yes, we have understood the concept here. Okay, so our concept of portfolio construction we have understood. Now, what are all the variables required to calculate the shared single index model? One thing is I need share price so that I can calculate returns. I can calculate risk. Risk further classified into two categories. One is a systematic risk, which includes even beta, and second one is a unsystematic risk. And third variable, we need the cutoff rate. For cutoff rate, this is the formula what we can see here. This is the market variance. It is the cumulative value or sum of individual stock return minus risk-free multiplied with the beta coefficient, and this is the unsystematic risk. Unsystematic risk is denoted as standard deviation of EI square. Unsystematic risk, okay, variance of the market, okay, unsystematic risk. Coming to the next point here, denominator is again 1 plus again market variance multiplied with cumulative value of beta I square divided by again unsystematic risk. Okay, this is the calculation of CI, and many of you would have known that what is the meaning of beta, how do we calculate beta with the different methods. Okay, it is shown here. Here, try to understand the systematic risk is calculated beta I square into variance of market index, that is beta I square into standard deviation of M square or sigma n square. Second one is unsystematic risk. Unsystematic risk is calculated total variance minus of each individual stock minus systematic risk. We do get unsystematic. If I add systematic and unsystematic, I do get total risk. Okay, this is the concept of Williams-Shaped single index model. Now, coming back to here, now I'm just bringing to your notice that our target is portfolio. We understood what you mean by portfolio. I'm bringing a very clarity to you, okay, because many people do have a misconception that if portfolio word, whenever people hear, they consider that only in stock market. No, not necessarily. Okay, that is what you should have a clarity. Okay, so we understood that portfolio, if you are investing into the different securities, then it is called as a portfolio. Once we know the portfolio, then immediately, okay, once we understand that we are going to invest into only the stock market, we have to construct a portfolio. Okay, when again in the stock market we have a different instrument which we have seen here, and in this we are taking here, there are many stocks. We want to identify which the portfolio construction, even though there are many methods, we are considering the Williams-Shaped single index model for our discussion. And also we have seen that what are the important formula, what are the steps, the background of single index model also we have seen. Now these are the variables we have seen. Now the real challenge lies here. We will directly work it out a problem by using MS Excel, and we will construct a portfolio and we'll check it out, okay, which the model recommends, which are all the company stocks. Now, as I told you, there are 1,300 plus companies actively trading in the market. You can have a different parameters to select, such as highest market capitalization of each sector. You're taking 5 companies or 10 companies, or you are keeping certain parameters or fundamental parameters. If each sector 5 companies, I'm going to consider if the last 5 years revenue is more than 20%, only those companies I'm going to consider. Okay, you can have any parameters for selection. Okay, for here, for simplicity purpose, what I have taken for this discussion here is data. Here consider that BSE 30, BSE Sensex 30 companies which is listed. Okay, I'm taking these 30 companies. Okay, I'm going to apply the same single index model And I wanted to test that. Is model recommends any of the companies to invest? That's what we are going to check it out. Okay. However, here further there are few more steps are available, like in the case of proportionate investment, you wanted to do it, how much you have to do it, what is the steps for that, also it is there. But however, my discussion restricted to only the construction of portfolio. Hence, what I'll do is I have ignored all those steps. Okay. Yeah. Coming back to here. Now, check it out here. I'm taken share price, monthly share price from January 2010 to 2021 April, almost 11 plus years monthly share price I have downloaded for this. And I am using here MS Excel, that is spreadsheet for construction of portfolio. Even you can use Python or R programming to do the same. And one more very important point here is risk-free rate. Many of us, we fail to take the risk-free rate properly. I have taken here 6.0050%. This is as per the government securities of 10 years rate of the bond which is issued by RBI. You can find this information in the RBI website. Okay, so long-term rate interest which I have considered 10 years bond rate, which is right as per yesterday, which is quoting this is the rate 6.0050. So now onwards, I consider that risk-free rate as 6.0050%. Okay. Now, till now we are clear. Okay. With this, let us quickly check it out. The Excel calculation, I'll show you. Just a second, give me a minute. Is it my Excel sheet is visible? Please confirm.
Yes, sir, it is visible.
Thank you so much. So here you can see this all the as per last month. Okay, these are all the 30 companies which consider for calculating Sensex. Now, what I'll do is I'm taking the share price of these companies, all 30 companies, what you can see here. Okay, and I'll construct the portfolio for this. Okay, let's see. Majority of us, we are aware that how to download the share price, so that I am skipping that particular part. Okay, there are many websites which you can download, such as directly from NSE website you can download, BSC website you can download, moneycontrol.com, from that you can download, or Capital Line database if you are having, if an institution is having its own database, from that also you can download. Okay, so this is the share prices which I am taken here for all the 30 companies. Okay, now what I'll do is I'm just copying this. I'm going to the new sheet and pasting here. Okay, share price of all the companies are there. Now, if we look at here, this is January 2010 till April 2021. You can see also here it is almost 136 observations or count. Okay, so this is the Sensex value. The first one you're seeing is Sensex value, which in 2010 it was 16,358. Right now it is around 48,000 as per last month, April month. Okay, so this is the price values. Okay, same thing for Asian Paints. Okay, Axis Bank. Okay, Bajaj Finserv. Okay, so all the companies are here. Just we'll have a count here. Let's see. So you can see here count is 32. One is a month and second one is a Sensex. So 30 companies I have taken here. What I have downloaded is I have downloaded all the prices. Preferably take the closing price. Is majority of the research work, do follow that one. So here the same thing I have done. I have downloaded the share price. coming back to the next concept. All this I have to convert into the returns. Okay. So all of us, we are aware, we may convert this. Just a minute. I'll take it the same. So here, this is the returns calculation I'm doing here. So there are many ways of again calculating the returns. Okay, so preferably it is always suggested if you take the log return. Okay, instead of just simple mean return like today's price minus yesterday's price divided by yesterday's price into 100, which gives us the answer, right? So preferably always prefer to take log return instead of mean return. So here what I'm calculating here is, since you're all studying in masters, hence I'm discussing all these things as a research point of view. Okay, ln is the function in Excel which calculates the log return. Okay, so for Sensex, today's price, that is February month, divided by the January month into 100 is the concept of percentage. So here I got the answer. Now what do I do is, if you calculate that calculation further, all the calculation will become easy. And believe me, this entire calculation does not take much time at all. All this calculation won't take much time. Okay, within few minutes you can calculate entire portfolio construction. Now I just double clicked, I got every month's calculation, returns calculated values you can see here. Okay, I'm just dragging the information here so that every 30 companies what we have taken is calculated. If it is 50 companies, you do it, 100 companies, you do it. It takes hardly a minute, hardly a second to calculate all those things. Now what we are seeing here is, it is all returns. Okay, log returns. Usually for research point of view, we consider that log returns. Okay, now for our understanding purpose, I am calculating here. Not necessary, there is no significance to do the sum. Okay, so here I'll say the total. So sum of all these things is called the total. Okay. Usually we go for average. If I drag, automatically I'll be calculating all the companies' sum. Now average, if you remember, all these things is a per month I have taken. So average supposed to be a per month. Average supposed to be a per month. Okay, equals to average is the formula which we follow in the Excel sheet, so that we got average per month. All the returns usually kept per annum, so that average per annum. Very simple. I'll multiply into 12 so that I got per annum. Means difference. This 9%, 9.7%, what you're seeing here, this indicates that I have taken here the same heading so that I can see that which company it belongs to. So this is Sensex return on an average every year. The market is giving us 9.7% as a return. This is what the meaning. Okay, coming back to the, we need standard deviation. Okay, then we need variance, then we need beta. Okay, we need beta calculation, then we need systematic risk, unsystematic risk. Very simple. Once if we put a formula, okay, just drag, automatically you will be calculated every calculation. You know that standard deviation, SPDEV, okay, P or S, okay. Usually we consider the S because of the sample instead of the population. So here again, select all the returns value and hit enter, you got the standard deviation. Sir, how do we calculate variance? Very simple. Standard deviation into standard deviation is called as a variance. Standard deviation into standard deviation is called as a variance. If we cross check here once again, as sir, can we calculate root of variance is called as a standard deviation? Yes, you can cross check, equals to SQRT, square root of variance. Okay. If we hit, the same answer you're getting here. Okay, so here I'll just delete whatever we have calculated. It is appropriate as of now. We're supposed to calculate beta. So beta, this is for market. Always we calculate beta market with other stocks. Correct? Hope you would have studied the same information in the in your class. So here the first one is, I'll be writing 1 because Sensex with Sensex always it is 1. From here onwards we have to calculate. If we look at the formula here, there are many different formulas. Okay, but Excel, will make our life very simple and easy, where you can use the function called as a slope, is also called as a regression. It is nothing but a beta calculation. Okay, slope of here ratio in that known y and known x. X is always market and y is always your individual stock. So what I'll do is I will select entire y column, comma. Now it is showing the known x. This is all x, market is x here. Now what I'll do is I'll freeze this cell because every company should be calculated on the market. Hence I'll put F4 or dollar symbol so that I freezed the cell. I hit the enter, I got the value. Okay. So now what I calculated here is Asian Paints beta I calculated. What it indicates, what this 0.68 indicates, for every 10% returns of Sensex is equals to 6.8% returns of Asian Paints, vice versa. If 10% fall down by Sensex, 6.8% fall will be there on Asian Paints. That is the meaning of beta over here. It is also called as a systematic risk. Okay, if I just drag this, okay, I will be calculated for all the companies beta. Okay, if I double click, okay, you can see here highlights of this company, that is Bajaj, okay, compared with Sensex. Same thing if I click here, this company with the Sensex. So I calculated the beta. Now left out is what? Systematic risk and unsystematic risk. Okay. How do I calculate systematic risk? Very simple. You can see here beta I square, each individual stock's beta into beta multiplied with market variance of the market index. Okay, so here what it indicates here is beta square multiplied with market variance. Okay, so here what I'm calculating here is equals to beta into beta again into market variance. This is the market variance because it is the Sensex. Okay, I will freeze this cell. The reason is because I have to multiply market variance for all the other stocks, remaining stocks. So It will be remain same as per the variance of market, but it will change for the companies. So successfully we have calculated systematic risk. Again, if we look back our formula for unsystematic risk is total variance of each individual securities minus systematic risk. Okay, so each individual securities variance minus systematic risk. Okay, what do we do here is just you drag all these things. So you have calculated, just a second, here standard deviation, so that I calculated returns, sum, all the details I have calculated. Okay. Successfully we have completed here. Okay, last one more task is there. Sorry. We'll calculate the unsystematic risk also. What is unsystematic risk specifies here? Unsystematic risk equals to total variance of individual stock minus systematic risk. Okay, we know the systematic risk which we have already calculated. This is the systematic risk which we have already calculated. We know the individual variance. Okay, so here equals to variance minus systematic risk. The first one supposed to be 0 because it is the market. Okay, and I have calculated remaining all variance also I calculated. So successfully we have completed all the variable required to construct the portfolio we have created. Now what do we do? The first step is over. If we look back here, our steps for calculation. Okay, so the first returns calculation is over. Now what do? We have to check it out, find out the excess return to beta ratio. This one we have to do it. For that, what I will do is I'll copy all the information. Copy this information. I'll put it here only. Okay, as I'll transpose convert into the values and transpose. So I got all the information here. So successfully it is kept in the vertical format. Now same information I'll copy and I'll go to the new sheet and I'll paste. Okay. So till here is over the calculation. So I'll say that company our step over here is we have to find out the excess return to beta. Okay, now before to this, here certain information which is not important to us, so that I'll remove. Total average per month I don't need, so that I'll remove it. Not necessary to keep it. So remaining all, yes, it is required, so that I'll keep it. Now this is what we have to do it now. Ri minus Rf divided by beta. This is called as a beta ratio, excess return to beta ratio. Okay, we know that. I have already given you the information. We have considered 10 years bond rate. This is the rate which we have taken. So same thing I'm keeping here, equals to, this is the average return. Okay, for your understanding purpose, per annum return is there. No, I will be converting into the RI. So here equals to average return minus risk-free rate 6.005 divided by beta. That I'll be getting the answer over here. So successfully I calculated x is written to beta. Coming to the next point, what I'll do is I'll copy the same information since I don't want to do it in the same sheet, so I can show you the differences, hence I'm taking it to the new sheet. So here, the next step here, rank them the highest to the lowest. Rank them from highest to the lowest. We have to give a ranking here. Okay, I'll write here ranking. So I take here rank. Now, this one I have to consider and I have to check it out that which is highest I have to give first rank, which is the last one I have to give 30th rank. So Excel will help us to do this, which I can use the sort. You can see here largest to the smallest. It will ask that do you want respective other cells also change along with these changes? Yes, sort. So that I got the answer here. 45, 29, 17, 16. So it is largest to the smallest. I got it. So I can give here now first rank to the last rank, 30th rank. So successfully I calculated even ranking also. Now what step left out now is for us the last one, cutoff rate. Hardly takes a time again. Okay, but here we should understand. Okay, yeah, I will just highlight this. This is a Sensex. Okay, so what I'll do is Sensex I won't consider. I will be considering the companies instead of Sensex. Correct. I'll take out this rank, I'll delete, and I'll keep here this is 10 and this is 11. So that if you check it out at the end, it should be 30. This is the 30th rank. Now, till now, I think all of you are clear with that assumption. Okay, I'll go further. I'll copy the same information. I'll go to the next sheet. Now, I wanted to create a portfolio here. So, here, what I'll do is I wanted to create a portfolio. Okay, so when I wanted to create a portfolio, what I'll do is I'll remove this Sensex because I don't need Sensex. What else I'm not required? Rank I don't require now because it is as per the ranking only now. Okay, I have removed it. And certain information like standard deviation, variance is not required. Okay, for time being I will hide. Okay, so this is the information right now we have. Now the bigger challenge to us is we have to calculate the cutoff rate. Okay, you all believe it or not, the model will suggest now out of whatever we have calculated, till now, out of 30 companies, which are the best company to invest? That is what model will going to suggest us. Now in this, I will copy the formula, what you can see here. I'm just copying this formula. I'm writing here. I'm keeping here. This is the formula. Now I have to calculate the numerator part of and denominator part of it. Okay, so numerator part I'll be targeting. I'll be multiplying this market variance at the end. First I will calculate this part, that is Ri minus Rf into beta. Okay, close the whole bracket or here into beta divided by unsystematic risk. unsystematic risk. This is the formula. This is the formula. Okay. How do I calculate for this? What I need is unsystematic risk I need, which I'm having here, unsystematic risk, Ri minus Rf. Okay. We know that here, just a minute, give me a minute. Here, we know that Rf is 6.005%. Then market variance. We need market variance. Okay. So if we come back here, returns calculation, we can see here, this is the, okay, this is the Sensex and this is the market variance. Let me highlight this. 25.62 is the market variance. That remains same. I'm taking that over here. I'll repeat. The market variance is Sensex variance is market variance 25.62. 25.62%. Okay. So now if we are having this information, I can calculate this, this particular part. Okay. Here, what I'm calculating here is equals to, I'll open two brackets, return of individual stock minus risk-free rate, which we are aware 6.005, close the bracket, into beta, this is the beta value, again close the bracket, whole divided by unsystematic risk. Okay, we got the value of this particular part. Now, what we should do is, this is the sum of the Ri minus Rf into beta divided by unsystematic risk. Hence, we have to calculate cumulative value of that. How do I calculate cumulative value? The previous cell value plus above value will be called as a cumulative value. Okay, if I click here, double click, okay, this value plus previous year total will be getting as a cumulative value. So now, till here, clear, all of you. Now what we need here is, we need to do the construction of the same. So I'll just copy here for the time saving purpose. I'll be putting here. Now we want the numerator. Okay, so entire this part I'm discussing now, entire this part, numerator part. How do I calculate? I know that sum of Ri minus Rf into beta divided by unsystematic risk. Therefore, I have to multiply with market variance. I will freeze the cell into the cumulative value. So successfully we have calculated numerator part. Successfully we have calculated numerator part. Denominator. Okay, for denominator part here we have to check it out, beta I square divided by unsystematic risk. Okay, beta I square, what we have to do, we have to put the bracket, okay, into divided by unsystematic risk. Let us calculate the same here, equals to beta into beta, beta into again beta, close the bracket, divided by unsystematic risk. So I calculated the denominator, only this part. I have to sum of this, so that again I'll go for cumulative, equals to same procedure what I have followed previously. I'm taking the same procedure. So successfully I calculated till here the part. What I have to do, I have to multiply market variance and I have to add 1 for that, so that the calculation will be over. Okay, here denominator part, what I have to do, equals to 1 plus, open a bracket, market variance. This is the market variance. 25.62 is the market variance. I'll freeze into cumulative of this. So I got denominator value also. So successfully over numerator and denominator part. Successfully completed numerator and denominator part. Now what is the calculation left out is just divide numerator divided by denominator equals to numerator divided by denominator. Okay. So numerator divided by denominator. So if I double click, okay, you got cutoff rate also. Now you're all going to get a surprise over here. Okay, see, just increase the size. Okay, here 3, 2, it is increased to 6, again increased to 9, again increased to 10, again increased to 10.5. Now from here it is decreased. Okay, 10.5 to 10.4, it is decreased. So that I have to stop it here only, and I have to say it is the C star cutoff rate. Okay, just highlight this. Now many students make a mistake also. Please check it out. Rest all should decrease. Every company's stocks should decrease. If anywhere it is increasing, then you made a mistake. Okay, check it out here. Every point it is decreasing till end. Everywhere it is decreasing. If you look at 3.6, 3.5, 3.2, 3.1, 3.0, okay, everywhere it is decreasing. So what happens if this is 3.5 and this is 4? No, you made somewhere mistake. Okay, that is the power of the concept of model which specifies. Now, what we have done here is we applied Williams-Shaped single index model. I'm going to highlight now. Williams-Shaped says that these are all the best company to invest. HUL, Nestle, Bajaj Finserv, TCS, and Ultratech Cement. Okay, there are 5 companies which are best to invest. Okay, so now what I'll do is, just a minute. Yeah. So these companies, I'm not recommending you to invest. Okay, again, that is the disclaimer I have made. Okay, you further, what you can do is you further analyze, okay, and check it out. Is this model really works in Indian context or not? If at all, if I invest from April month onwards or a period of certain time period, okay, is this 5 companies gives a good returns to me or not? Okay, that kind of research works gives you a lot of confidence. Okay, fine. I think I have to stop it here, okay, because of the time constraint. Okay, so over to the coordinators. Please let me know if any further questions or here. I'm happy to take them.
Thank you, sir. Sir, there's question from Pranavi. She says, sir, how is SHARPE index model and Markowitz model different?
Okay.
And add on, sir, when do we have to calculate Tocbm method?
Okay. See, the very basic concept over here, what I have explained to you. Okay, I'll just share my screen once again. Give me a minute. So initially, this is the model. Okay, Markowitz model is the model which they have applied. Okay, the drawback of the model leads to the next model is called as a Williams-Shaped single index model. Okay, when do we use the model? Okay, you can use either the model, but provided, okay, usually the model, if you're using the Markowitz model, is also called as a modern portfolio theory. Okay, the calculation part will become more difficulty. For example, here you can see here beta I have calculated for 30 companies. I have taken 30 is the beta. You can see here the count. Okay, but if I go for Harry-Markowitz model, what happens here is the concept here is n into n minus 1 divided by 2 is the concept. When we do this for 30 companies, if I take it, okay, so here 30 into 31 divided by 2. When I do it same here, 30 into 31 divided by 2, okay, 465 correlation required. Okay, probably I'll show you here. Yeah. So I think this is visible. The screen is visible to you?
Yes, sir, it is visible.
Yeah. This is the correlation matrix of 30 companies. Okay, if I select only this, okay, only the numbers, or here, okay, you can see here the count are very high. Okay, this many correlation required. To avoid this, okay, the beta concept has took place, so that it will be easy. Okay, her question is, when do we apply? Okay, you can apply anytime, but only thing is that the method of calculating will become huge when you apply the modern portfolio theory. And coming to the CAPM is the next further to that question. Okay, CAPM is calculated for each individual stock, whether it is overvalued or undervalued. In that context, we use CAPM model, or for calculating the cost of equity, we calculate the CAPM model. Hope I answered her question.
Yes, sir. Thank you so much, sir. So there's another one question from Vinay. So do institution portfolio perform better than the private client? Does acting on news and forecasting result is better in performance? Is the question that is being put across from Vinay, sir.
Okay. Yes. The one and very simple answer is yes. I need not explain much, because usually institutional investors do adopt a lot of good models, and they do invest. That's the reason for them it will be called as fund managers. Okay, and if you look at the mutual fund returns on an average, very surprisingly, it is more in India. It is more than 15%, which it is providing. Okay, it's amazing returns. That's all the fund managers, portfolio managers. Yes, he's right, ma'am. Any other question?
Sir, that is all the question. So thank you very much, sir. With this, we
okay. Just a minute. I'll again thank everyone, especially I would like to thank my teachers, especially Dr. G.V. Keshavrao sir, Dr. V. Rajesh Kumar sir, Dr. Purushottam sir, and Vikram sir, and all my teachers. Thank you so much. And thank you very much for inviting me to this workshop. Hope it will be benefited to these students. Once again, thank you, Principal, Dr. Nikita ma'am, and Chitra Devi ma'am, and all the coordinators, faculties of Oxford College. Thank you so much. Yes.
Thank you, sir. So with this, we come to the end of the workshop on portfolio management. It's my privilege to have been asked to propose a oath of thanks on this occasion. On behalf of Oxford College of Business Management, I would like to thank Professor Dilip for sharing his knowledge in detailed piece of information. It was great help in enhancing our knowledge too, sir. Thank you, sir, for taking time out of your busy schedule to be with us here. Thank you once again, sir. I would like to extend my gratitude to our principal, Dr. Nikita Alur, for taking the initiative in conducting such webinars. Thank you, ma'am, for being such an inspiration like you have always been. Special thanks to Mr. Prakash for technical support, and I extend my heartfelt thanks to all the participants for being part of this session today. The feedback link will be shared in the chat box. I request all the participants to fill before leaving. Thank you so much. Have a good day.
Thank you all. Thank you so much for giving me an opportunity. Once again, thank you so much. Can I leave the meeting since I have some other work? Immediately I have to join.
Yes, sir.
With your permission. Thank you so much. Thank you so much for inviting. Thank you so much. Good day.
Thank you.
Thank you.